You're listening to the Financial Source podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. Today, we're really trying to pull together a lot of different threads from a complex global markets briefing.
Yeah, it covers pretty much everything. FX, commodities, trade, even geopolitics.
Yeah.
Exactly. And our goal here isn't just to list things off, but to, quickly get to the heart of what's driving the global economy right now. We're focusing on that one big theme, risk sentiment. That's definitely the way to go. If you're prepping for a meeting or honestly just trying to figure out where the money's moving, you need to get the mood. And right now, that mood is, pretty clearly risk aversion.
Risk aversion, okay.
Yeah, and we're going to track that theme, that desire to play it safe across all these different reports. Because understanding that need for safety is probably the best shortcut to figuring out the market right now.
Okay, good plan. Let's start with currencies then, our currency compass. Now, looking at the main dollar index, the DXY, it's actually a bit softer. That feels counterintuitive. If everyone's risk averse, shouldn't the dollar be soaring?
That's a really good question, and it shows why just looking at the headline number can trick you.
Yeah.
The dollar is the ultimate safe haven, sure.
Right.
But the real story here is more subtle. It's a classic flight to safety within the big currencies, the G10. You see it really clearly when you look at the Japanese yen and the Swiss franc.
Ah, the other havens.
Exactly, they're firming up.
Yeah.
And then you look at the other side, the currencies tied tightly to global growth and trade. Think Aussie dollar, kiwi dollar.
The risk-on currencies.
Yeah, those are lagging
badly.
So that pattern tells you investors are definitely ditching risk, even if the big dollar itself is kind of stuck for other reasons.
So why is the dollar stuck? If fear is the main driver, why isn't everyone just piling into dollars?
Well, it's a mix of things, really, a push and a pull. Take euro dollar, for example. It's grinding a bit higher, but that's not really because the euro is suddenly super strong. It's more that the dollar just doesn't have the fuel to rally hard right now. You've got some political relief coming out of France, a bit more clarity there, which helps the euro find a floor.
Right, less uncertainty there.
And at the same time, you still got those U.S. bank worries just simmering in the background. They won't quite go away.
Ah, the domestic issues.
Yeah. That domestic uncertainty kind of neutralizes some of the dollar's usual strength when things get risk-off globally.
Okay, that makes sense. But the move that really jumped out at me was dollar-yen. It actually dipped below 150 briefly. I mean, 150 is usually such a huge psychological level, and normally the interest rate gap between the U.S. and Japan just keeps the yen down.
Exactly. And that's why that dip below 150 is so significant. It really shows you how powerful that demand for safety is right now.
Powerful enough to ignore the rate spread.
For a moment, yeah. It means the market basically decided, okay, global anxiety and needing liquidity is more important right now than locking in that guaranteed interest rate difference. That's strong haven demand just swamped the rate differentials for a bit.
Wow.
And sticking with Asia, there's another key signal coming from the currency markets we need to mention.
The yuan.
Yeah, the Chinese yuan. You have to notice what the PBOC, the People's Bank of China, is doing. They set the daily fix for the yuan, much stronger than anyone expected, 7.0949.
Okay, what does that signal?
That's a very direct, deliberate move. They're telling the market they want to stabilize the offshore yuan, the CNH, especially with all the U.S.-China friction going on. A stronger fix like that is basically Beijing saying, we're watching, and we're going to prevent destabilizing capital flight. It's an active intervention.
So currencies are clearly showing capital hiding in safe corners. If money's hiding, what about the physical side? Commodities, how are they reflecting this anxiety? Are they telling the same story?
Oh, absolutely. The commodity markets are trading completely in sync with that macro anxiety. Look at crude oil, WTI, Brent, both benchmarks.
Yeah.
They're continuing a pullback we've seen recently. They're pushing towards the lower end of their recent trading ranges.
Why the pressure?
It's two things hitting at once. First, those general risk offloads we just talked about. Traders are selling risky assets, and oil is definitely seen as one. Second, that's happening just as the diplomatic tone around the U.S.-Russia talks seems No, a bit steadier.
Okay, less tension there, maybe.
Any hint of de-escalation, even just slightly better language, tends to pull some of that geopolitical risk premium out of the oil price.
Oh,
So risk off plus maybe slightly less geopolitical fear equals lower oil.
got it. And gold. Gold usually loves fear, but it's been bouncing around a lot.
It really has been choppy.
Yeah.
And this is important, it's staying elevated. It set fresh records just this week, and it's holding up near those highs.
So the choppiness isn't the main story. Not really. The high level is the story. And that elevation is purely down to, well, two things. Classic safe haven demand, people wanting a hard asset instead of paper, and the general policy environment. All the money sloshing around during these risk-off waves causes big intraday swings, sure, but the underlying reason it's high is just nervousness about, financial stability long-term.
Okay, now here's where, for you listening, the connection between financial market jitters and the real economy gets crystal clear. Base metals. They're softer pretty much across the board, and copper is specifically looking weak.
Why is copper such a big deal here?
Dr. Copper.
Oh,
Good old Dr. Copper, they call it, because it supposedly has a PhD in economics.
right, the bellwether.
Exactly. It's tied into everything, global manufacturing, construction, general economic growth. So when copper prices weaken like this across different exchanges, it's a pretty strong signal of growth anxiety.
And that connects back to...
It connects directly back to those banking headlines we mentioned earlier. General worries about trade deals falling apart, just that overall cautious mood. If the market starts to seriously worry about a global slowdown, maybe even a recession, demand for industrial metals like copper is one of the first things to drop. It's like the physical proof of the slowdown fears. That growth anxiety then feeds right into the next big source of uncertainty we're seeing. All these diplomatic headlines and trade talks. The trade tape seems really active and kind of tense. It really is active, and yeah, tense is a good word. Markets are definitely twitchy, reacting to every hint or rumor. Let's start with Brazil. Secretary of State Rubio and USTR Greer had talks described as very positive with their Brazilian counterparts.
Okay, positive is good.
Yeah, and they agreed to work towards getting Presidents Trump and Lula together for a meeting. Now, for markets, that's potentially huge. Any progress there could really impact flows of things like agriculture, energy. Major stuff between those two economies.
All right, but shifting to Asia, things sound less positive, especially around South Korea.
Yeah, that's where the language is really heating up. The U.S. State Department just came out and publicly slammed China for putting sanctions on some South Korean companies, specifically U.S.-linked affiliates of Hanwha Ocean.
Slammed them how?
They didn't just disagree. They called China's actions coercive. And they said China was deliberately trying to undermine U.S.-Korea cooperation. That's strong language. It takes a trade dispute and puts it squarely in the geopolitical risk category.
And this is all happening while the big U.S.-Korea tariff framework itself is still up in the air.
Exactly. We're hearing from officials in Seoul that it's uncertain, that's the word they used, whether the U.S. will accept Korea's position. Apparently, Korea doesn't want to make a huge upfront payment, something like $350 billion related to this new tariff system.
Whoa, $350 billion. That's a small change.
Not at all. It's a massive number. It signals this isn't just about tweaking tariffs. It's about a major rejigging of trade policy, supply chains, investment flows. The fact they're struggling to agree on that payment suggests some really deep disagreements on how things are going to work going forward. That number alone tells you how serious this is.
Okay, so mostly tension on the trade front? Any bright spots at all?
Well, maybe a small one, specific to one sector. There are reports that the U.S. might be close to giving some tariff relief for parts of the auto industry.
After a lot of lobbying, I imagine.
Oh, for sure. Intense lobbying. Right. But yeah, that's a headline you want to watch closely. Any relief there could help stabilize some supply chains, smooth out trade flows, especially across the Atlantic. It would be a little bit of good news against the broader risk-off backdrop. Okay, so let's recap. Currencies are running for cover, commodities are flashing warning signs about growth, and trade talks are adding friction. Let's zoom out a bit more. How is the bigger picture, geopolitics and domestic policy, feeding into all this? Geopolitics is just fundamental to understanding risk right now, especially for energy prices. Take U.S.-Russia. The White House called the recent Trump-Putin call good and productive. High-level staff are apparently meeting next week.
Good and productive. Markets like that kind of language.
They do. It immediately lowers the perceived tail risk, the chance of something really bad happening.
Yeah.
Now, if these talks actually lead to something concrete, like a clear plan on sanctions or energy exports or security guarantees, those would be huge market movers. They could push that oil risk premium down even further.
And speaking of risk premiums, The situation in the Middle East, around Gaza, is still incredibly sensitive, right? That must be weighing on oil, too.
Absolutely. The market is watching the ceasefire there like a hawk. We're seeing reports, specific details. Hamas saying tunnel destruction is delaying the return of hostages' remains. Then you have Israeli officials accusing Hamas of actually violating the ceasefire by holding on to remains they shouldn't be.
So, tit-for-tat accusations.
Exactly. And why does this matter so much for markets? Because every single headline about trust breaking down, about noncompliance, about potential violations, it feeds directly into that geopolitical risk premium in oil. If trust collapses entirely, the conflict could flare up again very quickly, and you'd see oil prices spike.
Okay. And then bringing it back home, policy-wise, we've got different views coming out of the Fed on tariffs and inflation. That seems like a key debate.
It really is. You had Fed Governor Murrin arguing recently that actually the negative effects of the tariffs haven't been as bad as people feared, suggesting maybe they weren't the huge inflation driver some thought.
Okay, one view.
But then you have Minneapolis Fed President Kashkari pumping the brakes a bit. He's basically saying, hold on, it's too early to tell for sure. He pointed out that these things take time to work through the economy lag transmission, he called it.
The effects haven't fully hit yet.
Maybe not. And he also mentioned the data is still kind of messy because of the recent government shutdown. So you've got two respected Fed officials looking at the same issue. One seeing the current data, the other warning about delayed effects. It shows there's real uncertainty even within the Fed. And finally, one more domestic piece.
Paying federal workers. How does that link back to the big picture, like the dollar?
Yeah, keep an eye on the Senate vote next week. They're supposed to vote on paying federal workers who've been operating without pay during the shutdown. Now, that might sound like just a domestic issue.
But it affects growth perception.
Exactly. If they can't even sort that out quickly, it introduces instability. It makes the U.S. economy look less reliable, less predictable. And that can directly hit the dollar's standing as the go-to safe currency. It affects the dollar's macro bid, as traders call it.
Okay, quite a complex picture. Let's try to boil it down. For you listening, what are the main takeaways from this deep dive? What's the state of play?
The state of play is pretty clearly dominated by risk aversion. That's the main theme. So what does that look like? It means in FX, the havens, yen, and franc are stronger. Oil is soft, partly because of those macro fears, partly because of maybe slightly lower geopolitical tension. And gold is staying high, purely on safety demand.
And lots of news driving things.
Yeah, the whole environment is super sensitive to all the diplomatic meetings, the trade talks. That's where the day-to-day market cues are coming from right now. So based on everything we've looked at, the key things you should keep watching closely are those U.S.-Brazil and U.S.-Korea trade talks, especially what happens with that massive $350 billion payment idea. Definitely. Also, any real news on auto tariff relief, what comes out of the U.S.-Russia talks next week, and maybe most critically, just how well that Gaza ceasefire holds up. Any cracks there could be significant. And maybe here's a final thought for you to chew on, tying it all together. We've talked a lot about this broad risk-off mood, this macro trend that's generally pushing oil prices down.
Yeah, the economic fears.
But think about how quickly that incredibly sensitive situation in the Middle East, the arguments over hostage, remains a pure geopolitical flashpoint. How quickly could that completely detach oil prices from the economic story? How fast could that specific conflict risk make the oil risk premium explode, regardless of the wider macro trend?
A real clash between economics and raw conflict risk.
Exactly. That tension is huge right now.
And that tension connects geopolitics directly back to your wallet. That was the deep dive. We'll talk to you next time.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.